How are you? Enzo DiCostanzo, clinical professor of economics and finance, St. Peter's University in Jersey City. This is the summer of 2020, June 2020, and we're going through the investment PowerPoints today. So we'll be doing that. The summer section had the Excel file already sent to you guys, so you guys have all that. The fall, if we use these videos again, I'm sure we'll be sending you the Excel files with the templates on there. And like I said, the whole idea is as I go over the videos, you filling those templates out. You should practice using the templates before attempting the homework. Like I said, attempting the homework is the last thing you do. Read the chapter, watch the videos, work out all the in-class examples yourself to make sure you understand how everything works. The fourth thing, number four, the fourth thing is working on the homework. Don't just rush to the homework because you're busy, kind of a thing. You got to be able to methodically work through all this. That's the skill that I'm teaching you how to methodically work through this material. Okay, so let's get through the PowerPoints, and we'll pick that up. Okay, folks, here we are. And actually, we can make this, full screen. Okay. I always love the picture, and again, that's what I'm teaching you, step by step, how to, get over obstacles. There's a lot of thought that goes into this picture. That's for sure. Okay, so the objectives, why corporations invest in debt and stock securities, the accounting for debt investments, the accounting for stock investments, the use of consolidated financial statements, how debt and stock investments are reported in financial statements, and distinguishing between long-term and short-term debt investments. And also, it doesn't necessarily, well, it does, but for the consolidated financial statements, you're going to model a whole entire balance sheet. Now, look, we started this course in chapter 15. Now we're into 16. So we didn't do the first 14 chapters with most classes. It's not going to work that way. I'm just sort of cherry picking some topics as we go along. But you have the book. You should maybe read the first 4 chapters just for your own sort of knowledge base, and the equity statement, initial investment, how net income adds, it gets appreciated or gets added into the equity statement, if there's dividends or if there's any kind of yes, I apologize, folks. Something happened just there. Whoop. The PowerPoint just kind of crashed on us. Sorry about that. I don't know what that was, but hey, folks, I apologize for that. This computer's 10 years old, and it's letting me know that it's 10 years old, I think is what just happened. So. Yeah, folks, I apologize. Just stand by until this reloads, and we'll pick that up. But like what I was saying, though, and I actually have some of it here in the Excel. This is the owner's equity statement, or the owner's capital statement, or the shareholder's capital statement, if you want to say it like that. This is an important. It's funny enough, that thing went out just sort of at the right time here. This is how, if you own a business, if you're a shareholder, theoretically you own a part of a business, what that really looks like. All right, it initially started off with no capital. There was an investment made. Some net income got folded in, or I guess, what is it called, accreted or accretion? When you add in something to what the money that's already there, a dividend or a drawing, and then you're left with a capital statement right there. So these type, and you can see I have all the chapters written down because I've been teaching out of this text for quite a while. I don't know. Is it going to be better if we just sort of maybe, well, I don't know. I don't know why we couldn't just do the whole screen deal. Can you see it like this? Well, let's make it. hopefully it doesn't go out on us again like that. But yeah, but those are the topics: short-term, long-term investments. But again, modeling out the whole entire balance sheet, and actually, it's going to be sort of clicked out of there just for a second. Where is it? And yeah, I'm proud of this. And I think we're going to get to this at some point. But the whole time, here's modeling an entire balance sheet, again, including inventory, including all the entries that you learned in the first 15 chapters. But again, not everyone, will necessarily have read those first 15 chapters. And no, again, I teach courses where I just teach you what's in my class. I don't sit there and say, oh, well, another professor should have done this or that. I mean, that's just kind of crazy, that's not what I'm not about that. There's people who think that way, but I don't think that way. The plant assets or the real assets part of it, goodwill, all the liabilities, the longer term liabilities, the stockholder. This section could be very complicated because it's authorized shares, issued shares. We spent a lot of time, I think, in the fall 2019 going over a lot. Again, not everybody necessarily had that opportunity, which is fine. But like I said, I teach you, just sort of the whole thing as we go along. But it's those types of topics. So this is a very good chapter in that respect. We always have this little sort of grid here: cash management, investment income, strategic reasons, why corporations do what they do. Oh, look, that's a whole, again, there's so many things that we see in accounting that we can go back to opportunity cost. But again, I don't necessarily teach that topic all the time. I try to teach it like once a year to my groups. I try to do a nice, interesting thing with everybody, every semester. I try not to, just drone on and repeat myself like there's no tomorrow. We try to make it, this is something very, very appealing. But opportunity cost is a very important topic, and it's certainly something to spend a lot of time on. Recording acquisition of bonds, bond interest, the sale of bonds. So yeah, that's all certainly very important, and we're going to look into that. Accounting for stock investments, less than 20%, between 20 and 50, more than of the shares. So if a company has 100 shares, you own 20%, that means you own 20 shares. If you own 50%, that means you own 50 shares. If you own 75, that's 75%. That's 75 shares out of every 100 shares. If it's 1,000 shares, if it's 1,000,000 shares. Folks, let me tell you, there's something I'm working on now that I'm really have my fingers crossed that's going to work. But in my consulting work, but again, with all the unrest, with the civil unrest in all the big cities in America, certainly with we had a double shot this year of just unforeseen things, and it's so funny. It feels like yesterday Trump was just getting voted in, and I remember in class going through the Wall Street Journal surveys and the media surveys saying, "Oh yeah, Trump's not going to win." I said, well, I remember saying Trump has to win these 6 states, and it's unlikely that he will, and then he did. But again, he was out there, and he was campaigning for. I remember we met him about a year before he really the election. I met him in the summer of 2015, and he's campaigning a lot. Certainly, what he's doing now is not mirroring, his rallies, and that's what he did. Trump sold himself as a brand, and this is somebody who has 20 years expertise, 20, 15 years expertise, in the American market doing that. And that's why he became president. And I knew that was going to, that he was on television for 15 years. I knew that was going to resonate with people, that people can be identified with him. Biden and all these other folks, it's just, I'm not trying to take sides. I'm not trying to tell anybody who to vote for, but, it's it's a shadier lift with Biden. But with Trump, people feel like they know him, and when people feel like they know you, they're gonna, be a little more inclined to sort of, look at you as sort of agreeing with you and supporting you. And I think Trump mastered that. And I think for a second time, he's being massively underestimated. I really do think. If I had a roll of dice, I think he's going to get it again. But that's not a common opinion among a lot of people. I know an economist up in Boston who was stiffed. Trump stiffed him on some consulting fees, and that happens a lot. That happens a lot more often than you think, especially with very wealthy, famous people. They just figure, hey, your payment is that you knew me. That was kind of your payment, or the deal didn't work out, and the guys were $3 billion, and he had the nerve to say something like that. But that's and some attorneys that I worked with, they had the same experience where they provided service and they didn't get paid. So I don't feel so. That's happened to me too. So I don't feel so. I'm in relatively good company with that type of a story. But like I said, though, there was a deal I was working on, and I'm looking at a couple 100,000 shares of a venture, and you know, that's not a small thing. Valuing and reporting investments, categories of securities, the balance sheet, which I discussed, realized and unrealized gains and losses, and what the classified balance sheet is. So these are all, I say that all the time, but it's true. These are all very good topics. And again, the more this you know, the better, the better you're going to do with this. We're going to focus, like I said, and I was going to make a video about this. Maybe over the summer I'll probably do it because it's June right now. But we're going to recover. The country's very strong. Okay, the country's very strong. There's unrest and there's disenfranchisement, but it's not the 60s anymore. That was a different time. You didn't have sort of the systems running. I don't know if all those folks working in New York are going to be so willing to say, hey, we don't need the police and we want to give up our lives. And I don't know how willing a lot of those guys making, and there's a lot of them, in New York, especially New York City. And believe me, Seattle too. Don't think it's not. There's a lot of wealth in these businesses. Yeah, the problem is there is that sort of uber wealth in these cities versus just sort of everyday people, and they're all sort of going to Starbucks at the same time. That's sort of the problem. And that's sort of what's going on. There's no simple answer. I wish I could sit there and say, hey, if we did this, if we did that. You got a lot of emotion, you got a lot of feelings out there. I think just the old Jesuit thing of including people. When people feel excluded, people feel pushed off, people feel ignored, you're going to get what we have now. And from the first day that I stepped into a classroom, I've always tried to, run things where it's very inclusive, and I listen to people, to what people say. And I think that goes a little, but again, I make a difference in my little world. My little world is the classroom and the people I interact with. But to do that at a national level with all sorts of ideologies and all sorts of agendas out there, that's a much tougher thing to pull off. And Trump kind of did, though. He didn't unite the nation. He didn't do this. He didn't do that. I think he did some pretty good uniting about 4 years ago. But it's Middle America that he united. That's sort of the difference. So, but like I said, I don't want to sit and get too political on these videos. But like I said, certainly, it's worth it to continue to spend time and everything. The systems aren't going away. The legal system's not going to go away. The economic system's not going to go away. The banking system, the loans, real estate, not the way we do things isn't going to really change that much. I think we're in for a rough 6 months. That I think, and I'm almost glad it's the summer in a way. Because when September rolls around, at the end of this year I think the Italians are very superstitious. I'm a big believer sort of in numbers and the years. This 2020 was certainly not a very good year, and it's not going to be, end to end in any kind of way. And the faster we get to Christmas and New Year's, the better, in my opinion. And we just hit the reset button for 2021, and there's no baseball. How do you live without baseball? I can't live without baseball. Sorry, let's get back to the content here. Stay on message, right? Like I need to stay on message what I'm talking about here. Why corporations invest? They have excess cash. They have earnings from investment, or they want a steady cash flow, investments from income, or earnings from investment income. The next chapter is cash flow, and for the summer section, I think that's all we're going to do. Okay, I don't think we're going to get to financial statement analysis because the first chapter was like a double chapter, right? That the debt chapter, the long-term liability chapter was like a double chapter. And actually, what I probably should have asked you to do, maybe you can do it if you want, or not if you want, but maybe I should put an email out or send a message out or note out. You should read the current liabilities chapter in, I forget what chapter it is. Current liabilities is in chapter. My computer semi-crashed here a little bit, so that's why things are a little bit slow in opening up. This should have been open before. You're going to hear me say this a couple times. The operating system is still Windows 7 on this computer. It's still going, so we're pretty lucky with that. But I know I need a new tower. I know I need to upgrade to Windows 10, and I got to do all that, and I'll get to it. But it's where the payroll chapter is. See, everything's again, and leaving this computer's been on for a couple of days. You should shut your computers down for a day or two and just let them sort of take a breath. Here it is, chapter 11, current liabilities. Payroll accounting, don't worry about it. But hit the current liabilities thing, and then long-term liabilities, investments, and then statement of cash flows. And we'll cross out financial statement analysis for the time being. Okay. But that's why corporations they want a steady cash flow, or there's strategic reasons, and it happens every few years. Maybe not every few years, but Pepsi, PepsiCo, Coca-Cola, those kinds of companies, do they own the bottling operations? Do they not own the bottling operations? Is PepsiCo a brand? Is Coca-Cola a brand? Are they a distributor? All those types, because a bottling operation needs trucks and delivery, and you see it out in the streets. You know, UPS and the post office deliver Amazon packages, but they also, now you're seeing more Amazon trucks, and they have their own fleet of, I guess that's the Prime guys or whatever it might be. But you know, they have their own fleet of delivery vehicles. So again, so at Amazon, there's depreciation on that, and they've got to maintain them, and trucks break down, and anything that's mechanical and runs on petroleum and has ball bearings in it, you know, can break down and takes a lot of maintenance. It's a far different thing than the brand of Amazon, the brand of Pepsi, the brand of Coca-Cola. But you're always hearing a lot of back and forth is, you know, when does Coca-Cola own the bottling operations? And I guess it depends on who runs the company, and just sort of the warps and wanes of the economy, and the price of the stock, and how the market is doing, and the business cycle basically. But you know, when it owns bottling, when it doesn't, because it's a plant, it's a person, they need health insurance, and you know, and that's and it's nothing but a drain on your operations. And again, believe me, if you're a brand and you don't have a physical operation, you're going to be far more profitable than having to pay heat, cold, you know, heat the plant, cool the plant, fix the plant, new machines, depreciation, pay the guys, you know, all that stuff, and the machine breaks down, and you know, all those. That's that's the old business model. That's what the whole reason why Coca-Cola and PepsiCo are more profitable, if they separate the bottling company and they have an interest in it, or they're a 50% owner, there's other shareholders, or whatever it might be. So that's, you know, strategic reasons. That's, I know I gave you a whole thing on the sugar drink industry, but that's what that is. Okay, that whole story is just simply that, where, you know, you're going to have a negative impact to earnings. It's almost like dead. I don't want to say it's dead money, but because I haven't seen the term dead money in this accounting book, but I've heard that expression in private equity, and usually I you know, you should be very careful with this. But when I'm around people, or when I was around people in the 2010s in private equity for all the years that I worked in it, you know, you could pick out the people who really read an accounting book and who didn't. You know, net and dead money, and all these wild terms out there that it's just you know, an abomination of sort of the vocabulary of accounting, that you don't hear it, and you know who really did the reading, who just heard something somewhere and just repeated it because it sounded interesting, you know, kind of a thing. You know, makes them sound like they think that people think that it's going to make them sound like they know what they're talking about by saying those kinds of terms, when those are really not accounting terms. Or people referring to expenses as as I'm just sitting here, there's so many things that are going through my head. People used to refer to expenses as trades. I said to myself, what are you talking about? Yeah, I said to myself, this guy doesn't know anything. And you know, it is what it is. But anyway, temporary investments in the operating cycle. So yeah, so look at this. If company, again, and Warren Buffett has said this, the worst thing is if you have a lot of cash. And it says, because then what are you going to do with it? Right, kind of a thing. With me, I start fixing my house, and I'm saying at this point, not fixing it is you know, after Hurricane Sandy a number of years ago, there's nothing to fix anymore. Now I'm just improving it. You know, a better bathroom, and before I was fixing things that had to be fixed. We had a door that was coming off the hinges, and we needed a new air conditioning system. We needed a couple of different things. But now it's the luxury fixing. You know, a nicer bathroom, or you know, the shower thing where the shower thing comes off and it's a flexible hose, and you know, now it's things we don't really have to do. You know, so when I get cash in my pocket, that's the path. And the contractor's like my buddy, which is kind of terrible, because when you like somebody, you want to do things with them and say, oh, how about this, how about that? And next thing you know, it's $10,000 later on something. So, but yeah, so cash, again, some kind of investment. Now, the whole inventory thing is, if you're, again, making Pepsi Cola, you make the soda, you put it in the warehouse, kind of a thing, and then you sell it. So then somebody owes you, you sold them, you know, you sold Walmart cases of Coca-Cola, and you know, they say, okay, we'll owe you. And that's in the accounting world, an account receivable is almost just as good as cash, as long as it's a reliable person you're collecting it from. So with a Walmart, if Walmart owes you money, I'd take that to the bank, that's you're going to get paid with that. Type of thing. If it's the corner or whatever, the corner store, that may not be true. So, and then the temporary investments is, you know, what are you doing with your cash in between making new soda, and you want to just, you know, now how companies can get in trouble, or not get in trouble, but a decision to be made is, okay, we're in the Coca-Cola business, we're selling Coca-Cola, we market it, we make it, we manufacture it, we deliver it to Walmart, we deliver it to ShopRite. But oh, well, let's play in the stock market. We have all this cash, let's do acquisitions, or let's do something that makes it seem more than sugar water salesman, which is basically all the beverage companies. They're branding, but it's sugar water that they're selling. So some executive level guy, and it's a slippery slope, because if you're in the semiconductor business, if you're in the telecommunications business, hopefully that business. And again, even that may not be the greatest assumption. If you're in pharmaceuticals or biotech or something like that, those businesses. But all of a sudden now, you want to play in the stock market, you want to play in the real estate market, or it's a slippery slope to get into a lot of trouble unless somebody there is really a financial guy who knows what they're doing. Intel, I know, when I was covering Intel and applied materials for Value Line in the 2000s, I remember Intel had their own venture capital business where they looked for disruptive. What they were doing is they were looking for the competition before it stood up and shot them in the behind, which is really what they were doing. And they would say, "Oh, we're going to fund you." In other words, we're going to fund you, take you over, and now your technology belongs to us, as opposed to you being a competitor, kind of a thing. So I saw that whole thing. There were offices there, office space. There was all sorts of stuff out there. And California's beautiful. It's North. I remember it was Northern California. It wasn't L.A. or anything. The Intels and the Yahoos and they're all between San Jose and San Francisco. Cisco's up there, and certainly IBM is in Palo Alto. Apple was born out there. The great high school, Stanford University. Jerry Garcia, the guy who was the lead singer for the Grateful Dead until he ended up killing himself, but he was from that area. A very creative, fertile part of America, a beautiful part of America. If I had to do it all over again, I'm not saying I wouldn't live in this area, but if money was no object, and etc., if I had enough, that would be a nice to live that type of the Brady Bunch life out there. I always in my head, if I was 25 again, that might be something that I would really consider again, because it was really nice out there. We had an aunt of mine lived out there for a number of years, but she came back for whatever reason. I don't know why. But anyway, so looking at this, but yeah, that's what you do with your cash. Are you investing in your business? Are you investing in investments, type of a thing? Regularly invest in debt and stock to do what? To house excess cash until it's needed, to avoid a takeover. I would say C, right? They said B, generate earnings. Okay, I would say the stronger one is generate earnings, but to meet strategic goals, type of thing. But again, if you're in banking, if you're in a pension fund, your business is investments. Okay, and it's not so much the economic investment; it's the financial investment. Financial investment means you're speculating on the value of shares of a company that's already out there. Once Intel does a debt issuance or a capital raise using equity or whatever it might be, however they're going to raise their capital, that's it. They've raised it. Now it's just the right to the cash flows of the people on those shares that's being traded. Okay, and it's always the prospects of what's going to happen tomorrow, what's going to happen in the future. And if you look at the stock market right now, it's not that far off, considering we have enormous social unrest in Los Angeles and New York City and Chicago, pretty much every big city in America right now. I didn't look to see if the stock exchange is closed. I know it opened, with this whole coronavirus thing and the virus is happening, but I would suspect it's not. I'm not seeing the ticker every day on Fox News. But generate earnings is what pension funds and banks regularly invest in. But sure. Okay, but meeting the strategic goals of your earnings. But let's not split atoms on that. Recording acquisitions of bonds, so there's a cost to these transactions, as opposed to what people in private equity would like to think. There's a cost to these transactions. So costs include all expenditures necessary to acquire these investments, such as the price paid, some sort of transaction fee. Again, bond interest, we looked at that in the last chapter, and this is just sort of the accounting of that. This chapter is half the work that the previous chapter sort of was, or maybe 3/4 of the work, or 2/3 of the work, or something like that. It's not going to be that deep, heavy bunch of appendices type of thing. But the cash flow chapter, I noticed, has a couple of appendices, and again, that's probably as far as we're going to go in the summer course, because it's the start of June, but still, you still have a lot of stuff you guys are working on. You want to calculate and record the interest revenue based on the carrying value of the bonds, time the interest rate, and the portion of the year that the bond's outstanding. Okay, and like I said, and we'll show you different ways in the journal to record those revenues. Is it dividend or something else? And yeah, and well, like I said, you want to keep in your mind's eye, have the equity statement in your mind's eye. Initial investment, you're adding another investment. There's net income, and then you're subtracting out a drawing or dividend, which subtracts from equity, even if it's to yourself, type of a thing. Sale of bonds. Okay, correct the investment account for the cost of the bonds or record the gains. Yeah, gains and losses. And again, that's the equity account. So gain is going to be a credit, a loss is going to be a debit. Loss on the left, credits on the right, type thing on the equity accounts. The proceeds and the net proceeds from sales. And again, we'll show you example-wise in the journal how all that happens. This is, yeah, so what happens here? You're taking a very liquid asset, cash, and you're converting it into debt. Now, there's a whole lot of other detail there. Doan Incorporated, 8%, 10-year, $1,000 worth of bonds, and you do, it's $1,000 pieces, you do 54 of them, all right, kind of a thing, and includes, yeah, so the 54,000 in this particular example included what you spent on brokerage fees. So that gets added, the 1,000 gets added into the 54,000. So it's 53,000 or 52,000, 53,000 plus 1,000 is 54,000. Okay, we acquired 50 of these bonds. So you could do the math on the side. So it's 53,000 divided by 50. So if you want to figure out what, I want to do this just for the math of it. So what are we doing here? It's equal 54, 1, 2, 3, minus 1,000. Divided by 50. So each sliver, each of the 50, it was 1,060. And then so if we look at this, so it's equal to 50 times 1,060 plus 1,000. Yeah, there's 54,000. Okay. So you've converted cash just to something very liquid to an instrument, which is might be a little less liquid, but still it's still an asset. It's on the debit side. Okay, it's still an asset. And who we're again, you gotta put your legal hat on with this. Cool as a corporation, and they acquired Doan's bonds or Doan Incorporated, 8%, 10-year bond, 10-year thousand. So Cool. Honestly, they made a loan, but they did a capital raise. Doan did a capital raise of 53,000, whatever it might be, minus 1,000 as the transaction fee, and they agreed to pay back 8%. They got the capital on January 1st, and most likely semi-annual 8% interest. So that's going to be $80. So $40 a year, something along those lines. Okay, and then they're going to pay the pool is going to incur another transaction expense. But again, you want to put your legal hat on. Who's doing what? Cool basically loaned to Doan, $53,000 is what happened there. Now you have the interest revenue. Actually looking at this, 80, right, and then 50 of them is what is that? 40,000. Is it? Let's see, 8%. Here, look, let's do it on the side here. Equals 8% times 1,000 times 50 times 1/2. Yeah, there's your 2,000. That's how you got that 2,000. So 8% times 50 of those instruments, half. So let's do semi-annual. That's where you get the 50. See how it's 50 or it's 2,000 here. All right, this was the 54. This was the initial capital raise. There's your interest revenue. Oh yeah, it's right here. It's done at the bottom here. Okay, so again, Cool acquired the debt instruments. Okay, including brokerage fees and semi-annual interest paid, and the receipt of interest on July 1st is the following. Okay, so yeah, so looking at this, right? So it's going to go into cash, is where it's going to go. Okay, this is all going to go into cash. So it's going to be interest revenue. Right, it's a revenue. It's like if you sold a case of Coca-Cola to the corner, convenience store type thing. Okay, so you're recognizing but this is from an instrument as opposed to selling a good. It's from a financial instrument, and it just piles into cash because you get the you get the receipt of interest is what you get. I apologize for that, folks. Okay, but yeah. So looking at this, we have this situation here. Okay, with the interest revenue. This is so yeah. This other one. So you received the interest payment in July. Then there's another one coming at the end of the year. As of December 31st, Cool or not Cool. Doan owes Cool another 2,000. Right now, it's the same. See how interest revenue is still a credit, but now it's a debit for a receivable as opposed to cash because you didn't get the money yet. When you get the transaction actually executes, then you get the 2,000 into cash. So you convert from receivable 2,000 to cash 2,000. And again, if Doan was Walmart, you're getting your money. So this in terms of the journal entries, and again, you want to keep the dates clear, the dates, the amounts. That's everything that I'm teaching you is that. Okay, every single thing that I'm teaching you is something like that. Yeah, now they sell the bonds, and again, we did a little computation here on the side. You bought these things for 54, you sell them for 58, so obviously that's going to be a gain. And yeah, so what you're doing is you're converting back to, you're selling the instruments. So if you're Cool, you're saying, okay, we're going to sell our stake in that is what we're going to do. So no longer are we recognizing a debt investment of 54,000. We're going to sell this to somebody else, and we're going to just sell it a year into because you bought it on the 1st of January 2012, and now it's a year later, and you have a gain on it, so somebody else is going to take over those cash flows. Or if this thing is just retired, then there's in the previous chapter we did that journal entry where Doan pays you back and they make the last interest payment and you're closing out your loan to them. Okay, but in this situation, a year later you're going to sell the instrument. You're going to make a $4,000 gain. Right, you bought it at 54, you're selling it at 58. All right, that's everyone's dream to do things like that. And notice with this, the gain is on the credit side of the equity account, and it balances the cash, because what happens is this asset gets written off. So what's happening is you're on the asset side here, you're going to credit this, you're debiting cash, the net is 4,000, the 4,000 debit on the asset side balances credit 4,000 on the equity side, which is the other side of the equal sign, and that credit is plus because it's equity account. Okay. An event related to an investment in debt securities that does not require journal entry. Yeah, so acquisition of the debt, and so when are you not entering and making it? Again, let's just the answer C. Let's go, choice by choice and figure out why it is and why it is not. An acquisition that definitely requires a journal entry, receipt of interest, journal entry, sale the debt investment, journal entry, changing the name. That's a legal. So again, things where if it's not an accounting maneuver, maybe a legal maneuver. It's not that it's not important, but certainly that's a legal step. Bonds are sold. The gain or loss is the difference between the proceeds and the cost, right? Not the sales price and the cost. It's what you're getting. See, and it's deceptive here. You could run and say sales price. That sounds pretty good, but it's net proceeds means that you take out the fees involved with the transaction. The sale price is just the sale price. That's it. It doesn't include transaction expenses, which are there, which are real expenses. Sale price and the market value, no. Proceeds, and so it has nothing to do necessarily, because market value and the sale price is the same thing. Okay, so and these are the same. So this is a complicated one here. Ownership percentages. So yeah, if you're 0 to 20%, there's no significant influence of what you're doing. You owning a company has no. You hear about the baseball team, the Mets out in Queens. Silent partner this, because silent partner that. Steve Cohen was going to buy more of it because the Wilpons wanted they wanted to sell the team because they got killed in the Bernie Madoff fiasco, and they're looking to figure out how to. I'm sure they're sorry that they didn't at this point. I'm sure they're sorry they didn't sell the team, considering how this year's gone. But the Wilpons got cleaned up by and these were sophisticated guys, but they were in their cocoon where, and I've been in many of those situations where you're around very wealthy people and everyone's just telling them yes, 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 and they're doing something that's really bad. And now, when you're very wealthy, you've got money for lawyers, you've got money to make mistakes that most just everyday ordinary people don't have. And they're surrounded by people who say, "Oh, good idea, Jeff. Good idea, Fred. Good idea this, good idea that." It's kind of a thing. They're surrounded by people who do that for them. But Cohen, the hedge fund guy, was going to buy the majority of the team, but he was a minority owner. He owned 5% of the team. I think Alex Rodriguez even owned 5% of the Mets, and now him and his girlfriend or his wife, Jennifer Lopez, I think they want to buy it all, and they're making a couple runs at this right now. And it's a good time to be a buyer in this environment, because now if you don't have to sell, you would want to hold on to your assets. But if for whatever reason you have to cash out, I'm sure behind the scenes that they're probably in a very dire situation, the Wolf bonds, that they lost all their money. They didn't get anything returned to them from whoever, from the Madoff guy. Didn't he die in jail, or his kids are dead? I have De Niro's version of that, and you can see it. But this is Wizard of Lies. It's De Niro playing Madoff. I'm looking forward to watching that. I got to get a chance to watch that. But so no significant influence is less than 20%. A little more influence, and the methods that you use: equity method, cost method, and we're going to go through examples that show the details of the cost method, the equity method, and then the consolidation version of this. And that's the balance sheet. So we're going to go do mathematical examples of everything as we go through the chapter. And again, folks, you got to take your time and really read through all this material. This is very good. Okay, everything that especially this year, all the stuff I'm going to teach you guys is very, very useful in business transactions of the very wealthy. And look, the reality is there's a tremendous career to be had with your legal function, your legal ability, your accounting ability, certainly your economics ability, your finance ability, all those functioning abilities. It's all those functioning abilities are that's what people are going to pay you to do. You can be all the philosopher you want, but they're going to pay to do contracts. They're going to pay to do projections. They're going to, the statistics function. Those are the 5 things. Those are the 5 ways to make money in New York City: legal function, accounting function, finance function, statistics function, and the economics function. Those are the 5 areas. And especially if you know something about all of them, you're really going to be in good shape. I kid you not. Accounting depends on the extent of the investor's influence over the operating affairs of the issuing corporation. Folks, pardon me one second. I think the way to not get hiccups when you drink on camera is to drink and just give it a couple seconds to sort of go down. I think I was talking too quickly. One of the videos I had the hiccups. I apologize for that. I feel very terrible about that. But anyway, these equity method, cost method, and again, we're going to go through equity method. Obviously, you're looking at the equity statement, and you're using that terminology to keep track of everything. Holding less than 20%, cost method, investment of cost, recognize revenue when cash dividends are paid. All expenditures necessary to acquire these investments include the price paid plus any brokerage fees. So again, the transaction costs. And again, this is just an example of that. So this is, again, this is cost method. So you bought 10%. So if 10% is 1,000, there's 10,000 share. No, 10 times. So this is 1/10 of ownership times 10 is 10,000 shares is out there. You bought 1,000 shares. You paid 40. And then, and as you're looking at, again, using the cost method, looking at how you did this, you have $40 times 1,000 shares, then plus 500. So that's a part of the cost of that's you paid it. So that's a part of what you needed to spend to buy all these 1,000 shares. Okay. Here's how you get the dividend revenue. Again, the cost method is dividend revenue. Okay, so it's $2 times 1,000 shares, which is why it's 2. And again, we'll do, and tomorrow's video, the next day, will be the Excel versions of everything. Now they sold it. So what did they buy this for? They bought this for $40,500, and they're selling it for $39,000. So so again, they're writing off their asset, so they're crediting it Okay, they're getting most of it back, but they're still having their equity loss is still 1,000. Again, it's on the debit side, but you're in the equity account, so that's a minus because you're on the equity side. You're on the right hand side of the equal side of the accounting equation. Okay, but again, all very useful, all very useful. Equity method is, so again, just keep in mind what this was. This was what cash, dividend revenue, all that stuff. Okay. Now, equity method, investment of course, adjust the amount of each period, proportionate share of the earnings or losses. Dividends received by the investor. So, investor share of the investee's losses exceed the carrying amount of the investment. The investor ordinarily should discontinue applying equity. Yeah, I mean, right. So, you're recording the investment of cost. You adjust the amount each period. Share the earnings or losses, and then dividends received by the investor. Okay, that says if the share losses exceed the carrying amount, and then you change methods, and that's a little more. That's if this was an accounting class, we would really worry about that. So under equity method, the investor records dividends. It's not revenue; it's going to be stock investment. Okay, so it's not this one; it's going to be this one. All right, this is equity method. How you recognize, and again, we'll show you an example of that. This is a 30% acquisition of the shares of Beck for 120,000. Beck reports 100,000 net income. It pays dividends of 40. So how do we? The company does. You own 30% of it. Okay, so you got to keep in mind the first January 1st is the transaction entry. So you pay 120,000. You get the stock, the ownership instrument. You have a document that says you own 30% of this company, and you're entitled to 30% of the income, and that shows up here. Where if there's $100,000 net income, you're entitled to $30,000 of it. So again, anybody who gets paid in stock, you're going to really care about these kinds of things. And then if you get a dividend, also you're entitled to a third of that. Okay, and again, you show it in cash and stock. Now, looking at this, you get the cash, but you're showing in stock investment that what could have gone into the equity account of the company came to you as cash. Okay, so it's like you're the owner, but you're also almost writing it off in a sense. You're writing off it's a drawing really, but it's to you. You're one of the owners. Okay, so you're sort of on both sides of the equation here with that. Yeah, this is the same thing, the same problem. And then we want to record postings. So the initial transaction was 120,000. The dividend was a write-off in a sense, and then the stock investment, a third of the income was that 30,000, and then the revenue from investments are here. So again, on the equity side, it's still going to be a credit. It's still going to be plus, and this 30,000 balances this. We don't have the 12, do we? They should have a dividend statement here also, but they don't have it. But I have it in the examples. But we'll show you that as we get to that. And this is more than 50% type of a thing. So it's a controlling interest. The investor is referred to as a parent. The investee is a subsidiary. So now we're getting to the legal areas of this. Investment is reported on the parent's books as a long-term investment, and the parent should prepare consolidated financial statements. Okay, which is what that is. Procter Gamble acquired Gillette. Again, this is if you're Boston, if you're in the Boston area, this is obviously a big deal. The stadium is called that, right? Where the football team plays. It's called Gillette. The Fenway Park is still there, but Gillette is the football. Obviously, for the NFL, they had to modernize. I mean, all the quaintness of baseball. The NFL was, I think, I don't say smarter, because baseball goes further back in the country and it's not as violent. So even though people say, oh, the NFL is the #1 property, but I think in people's hearts, people are still, America's still a baseball company and a country. And here's the thing, though. American style baseball is played in a lot of other parts of the world. I don't think you have American style football, because in the rest of the world, football is soccer, right? So I don't think you have the helmets and pads version that you do for for baseball. If you go to Dominican Republic, if you go to Cuba, they play baseball just like they played in America, and there's that synergy of that. But I think the NFL, what they did was they didn't fall for this, let's have a quaint old, Giant Stadium or whatever it might be, the LA Coliseum or something. There's everybody's stadiums in the NFL are modern. Everybody's. So the Patriots have, a supersized, stadium out there in Massachusetts. So the shareholder for Procter & Gamble, the board of directors, in turn selected officers, manages the company, controls the property owned by the corporation, which includes common stock. Fine. So there's a control. So now you're getting into the legal questions, and we'll answer these questions. But where on Procter & Gamble balance sheet will you find the investment in Gillette? And we'll get to that answer in a second. But there's a board of directors. They elect a board of directors to control Gillette. They elect the board of directors of Procter & Gamble, elect the board of directors to control Procter & Gamble, and then you have a single economic entity, right? Both of those together. To get the answer to this, it says where on the balance sheet, and I answered this in the notes. Let's just go to the answer so we don't make sure we say everything the right way. This is the textbook, so this is just page 756. You guys should have this. Yeah, so it says, how does that account for Gillette? Because Procter & Gamble owns 9%, it doesn't report it in the investment section. Instead, the assets liabilities are included and commingled with the assets liabilities of Procter & Gamble. So that's how. So owns only 9% of Gillette. Does not report it in the investment. Yeah, it's not in the investment section. I think it's using the cost method, right? I think that was the cost method. Okay. Is what that was. But again, these flow diagrams, this is no joke, and I was I was always being asked to do this stuff. When I worked in private equity in the 2010s in New York, I was saying, okay, make us a flow diagram for this thing, and that's a big part of it. Valuing and reporting, again, this is very innocent, available for sale, held to maturity, trading. And again, this is for the set of securities that when you're owning 20% or less than 20% of the company. When Gillette, Procter & Gamble owns less than 20% of Gillette type of thing. Okay, available for sale, trading, held to maturity, short period of time. Trading means frequent buying and selling. Fair value, report changes from costs as a part of net income. And again, we'll go through the math of all of this. Yeah, there's an intention of selling these things at some time in the future. They can be classified as current assets or as long-term, depending on the intent of the management. These available for sale is a real in between. They're reported fair value, and again, the change from cost as a component of stockholders' equity. And again, we have a math example that illustrates it, better than just a lot of words. Bought and held for sale in near term, or these are obviously trading securities. Okay. Near-term selling. Yeah, this is what we were in. So this is a stock or bond, but the cost, the fair value, the current stock price, how many shares you have, gain or loss, and then how you show the entry. And with this one, obviously, look at this. If this is a gain, right? Look at this. The market adjusts now, and you got to be careful with this. This is on the equity side, and this is on the asset side. Okay, is what this is, and you're keeping track of your assets. So if it's worth $7,000 more, right? Your asset that the market adjustment trading, it's worth $7,000. You're marking it up right there, and then you recognize a gain on the equity side, which is what this is. Okay. We'll go through all this. I don't feel like I'm just rushing through this. We're gonna go through all that. How would the entries change if the securities were available? Yeah, well, look at this. It says equity account is used instead. Gain or loss is going to be an income. Okay. The unreal would be deducted from the equity section rather than charged to. And again, now we're getting into the real, the tax accounting of this. Again, the point of the course is not so much that. But it's computing this stuff, which is the part of the course. So Albert has two securities. They're classified as available for sale. One of them has a gain, one of them has a loss. The net is a loss. So look at this. So again, you're writing down your asset by about 10,000, and then you're recognizing a loss on the debit side, which is negative on the equity side of the accounting equation, which is what that is. So if you look at this, you bought this at 93, now it's 103. You bought this at 200,000, it's 180. There's a $10,000 gain and a $20,000 loss, so you're at a net loss of about 10,000. Unrealized loss on securities is reported as a separate component of the cycle. Yeah, and it is, and we'll show you how that all happens. Okay, but that's we have that example sitting there for us. This is balance sheet. Yeah, the IFRS stuff we're not going to really hit that. So marketable securities that are held that are readily marketable tend to be converted to cash within the next year. Property sector, whichever is longer. Investments don't meet but are classified as long-term investments. Okay, so it's either short-term or long-term. And again, so again, in various chapters, we expanded our income statement. Loss on sale, interest revenue, dividend revenue, gain on sale, unrealized gain, unrealized loss. Right, this is all income statement, and this is how it's. And again, just your experience with, again, interest revenue. What is that? You have some sort of investment that's a bond, right? We're earning interest. Dividend obviously is for stock or equity, right? And it's throwing off some kind of dividend. And the gains and losses are just selling your instruments. And the unrealized are just what it is until you pull the string on the transaction. They're going to be unrealized gains and losses. This is available for sale. A report is a separate component cycle as equity. Yes, and again, in the balance sheet that we're going to model in the Excel section, there's a common stock part, a retained earnings part, total paid in capital, and then a loss, and then how you account for that on the partial balance sheet. This is Pace Corporation, and again, there's an investment section, the short-term investments at fair value, and you can see we're going to go through these layers of computation and the receivables, and again, all of this stuff is from previous chapters. We went over the receivable chapter, but again, depending on the courses, I just sort of plug in different chapters just to give you guys a variety of what we're doing here. But it's all very useful. Okay, there's no doubts about that. Stock of less than 20% owned company at fair value, between 20 and 50%. So you have those classifications. Okay, but again, we're going to go through the entire balance. This is just the investment section and the current asset section. There's a liability section. There's all sorts of other pieces to this that we're going to go over when we go over a whole entire balance sheet. This is just the international version of things, so don't worry too much about this unless you're studying for a CPA exam or whatever. And this is not an accounting class, so we're not going to worry about that so much. But there you go. Okay, so you had your presentation. This certainly wasn't as long as other and here just very clear. This was certainly not as long as other PowerPoint discussions. You have a current asset part, inventory, prepaid insurance, the investment section. We're going to go over this, including the transaction costs, land, property, building, equipment, total assets, goodwill, current liabilities, longer term liabilities, stockholders equity. But this is all. This is sort of everything we learned in 15, 16 chapters, all in one balance sheet is really what that is. But we're going to get to that. Okay. All right, folks. Like I say, I always like to say goodbye in person. Good luck out there. Keep watching these videos. Stay safe. Don't get too wrapped up in what's going on, folks. Like I said, the end of the year, the election comes, Christmas, New Year's. Probably a vaccine or something for the virus thing, which is probably on the way. You'll be all right, like I said. But just prepare for the future. Prepare for 2021. Maybe start studying for your CPA exam a little bit or something like that. If your CPA exams or whatever it might be. But good things are coming. Our best days are ahead of us, definitely, as a nation. So please, don't be overly concerned. This all will pass. Okay, everything that we're seeing will pass. The virus will pass. The protests will pass because it's too powerful of a country. The world wants what we do, right? The world wants what we do, and the world wants what you do. It's hard to deny the market that. So we're going to bounce back. Okay, folks, be well, be safe. We'll see you soon.